Good morning, everyone, and thank you and welcome to the second in our EU transition webinar series. We've just been waiting for people to arrive, so we're ready to get going now. This morning we're joined by Tracy Masters, EU Transition Advisor from Newable, who'll be sharing her knowledge and expertise with some top tips, best practice, and what you need to have in place to import and export. Tracy will also explain the free offer that's on support until the 31st of March, and we encourage you to take this up if there are any areas you need support in. Rupert Moyle, VAT and Duty Partner, and Andrew Wallis, Corporate Tax Partner, both from Kreston Reeves, are with us to update you on the changes to VAT, duty and tax. This is a huge area and we won't be able to cover everything in this session. So if you have any specific questions, they'll do their best to cover them. So please use the Q&A box for any questions. Unfortunately, Lawrence Boone from FIS is unable to join us this morning. We're always happy to pass on any questions that arise after the event to our experts who will be happy to help, and they will be sharing their email details in the chat box, so please take the information from there. Just a reminder to use the Q&A box rather than the chat box during the session to post your questions, and we can put them to the experts at the end. So Tracy, I'll hand over to you.
Thank you very much, Tracy. Good morning, everyone. Our role as EU Transition Advisors is a short-term role, intensive role from the 1st of January till the end of March, as Tracy mentioned. We're not VAT specialists or customs brokers, but we're here to try and support companies to disseminate the trade agreements, signpost them, and if required, contact departments within the government to help them. So please do take advantage of that. My remit today is to cover the movement of goods for sale and purchase, and also look at the important element of rules of origin. I'm going to touch a little bit on selling to consumers, but the next webinar on the 31st of March is focused on e-commerce and trading with consumers. So there'll be a lot more detail then, because there's a lot more involved in that. Drawing on the experience we've had since the 1st of January, the majority of companies that contact us are across the board, all sorts of sectors, mainly small and medium-sized businesses, but a few larger companies looking for specific support. Those that have seemed to have been most affected by the trade agreement and the changes since the 1st of January are those that don't make their own products or import them from abroad, and those that have previously only traded with the EU, so are not used to exporting around the rest of the world. Also, obviously, those companies that sell food and drink, products of animal origin, and they have had some significant changes in terms of what is required to get their products into the EU. Our nature of our work is more about problem solving, but there are companies who have successfully transitioned. Most of them have done so by securing strong relationships with their carriers, their freight forwarders. They've got good relationships with the Chamber of Commerce, they've sought VAT advice, and most importantly, have knowledgeable customers and suppliers who are all determined to continue to trade and have a willingness to trade. And what I wanted to do today was to look at that commercial model that makes it possible and makes it successful for you to trade with the EU. I'm conscious that time is limited, but I just wanted to run through some of the elements of the importation and exportation process that are worth you checking to ensure that you can continue to sell profitably to the EU. There are two important pieces of information you need to establish the costs of trading. The first is knowing the HS code, or otherwise known as the commodity code, of your product, and also the country of origin of your product. These are two crucial bits of information. When you've got these, you can establish what regulations surround your product to either import or export them, any licenses or certificates required, more importantly, the import duties, which Andrew and Rupert will come on to later, and if your product falls under any excise or controlled goods regime. So with these two bits of information, you can gain an awful lot of knowledge. Both the UK government and the EU, through their Europa database, provide all the information you need when you have that information. Now, the country of origin for some companies can be very difficult to work out. If you make your products in the UK, even if they're through imported materials, they become something else, they have a different code, HS code when they're finished, then you declare them as UK origin. That's absolutely fine. But if you're somebody who imports a product and doesn't do the necessary process required to convert it to UK, then you're in danger of, if you're selling for your customer, to pay import duties. Now, for every commodity code, there is a rule, and it tells you how to establish what your country of origin is for your product. There are pages of it in the trade agreement, and we are very happy to help you with that. But as I say, if you go on these databases, they will explain what the rule is, and then if you don't know how to interpret it, we can help you do that. You also need to carefully consider the regulations for your products. I'm very much focused on products here because it's about movement of goods. Now, if there are regulations required either incoming or going into the EU, trading standards are superb at helping you with that. Or also go to your industry trade body. They're all doing excellent work to help you in your specific sector to understand how to trade. For example, I'll give you a big change. If you export products to the EU from the 16th of July, you will need to appoint an authorised representative for your goods if they need to be CE marked. Now, this is very, very important, and something that if you know that you have CE or need to have CE marked goods, that you look at that and seek support to help you. And again, we can signpost you for that. As Andrew and Rupert will no doubt mention to you, the trade agreement is free trade, but it's only free trade for British goods going to the EU and EU goods coming to the UK. The Percy Pig affair you probably all know about now, but it's not free in terms of the non-tariff barriers. And these are the regulations that you need to follow. The consumer selling side is very, very involved. And as I say, please come back on the 31st of March to find out more about that. So we've looked at the HS code, commodity code as it's also called, the country of origin. The next important thing you must establish is the Inco terms by which you're prepared to trade, either buying or selling. These Inco terms will dictate who is the exporter or the importer of record on that transaction. I'll give you some examples. If you've got an EU business customer, very experienced importer, they may be happy to arrange the freight and the importation. Ex-works, maybe worst case DAP. These acronyms you can look up, but if you're not familiar with them. But a less experienced importer may want you to do it. They might push you to do DDP. You need to understand what's involved. It is the most complex of the Inco terms in terms of paperwork and cost. And I really encourage you to research this and have this knowledge. Whether you're buying or selling, it's important to understand what you're prepared to undertake in terms of those terms. So you've now got 3 pieces of information, and you can now go to your shipping company, your carrier, freight forwarder, and start getting some examples of costs. What I'm trying to build up here is the commercial element of trading with the EU. Even though you haven't got a fixed order maybe, you need to understand, because carriers especially have put on additional handling fees since the 1st of January to process the paperwork. So please, call a number of them. The other people I encourage you to contact are customs agents or customs brokers. If you are fortunate and you're selling to a big business who's happy you know, they've got a lorry going around, they're going to pick goods up. You've still got to declare your export. You've got to get that into the HMRC system. Now, if you're a large company, you've got trained staff and you've got the right software, then you can do that yourself. But more than 9 times out of 10, you're going to need somebody to do that for you. Now, these guys are doing it day in, day out. They know where the hotspots are in Europe. They'll give you an invaluable insight into what route your product might take, transit, all the various options. So please, you know, I know there are a lot of very, very busy people out there, but please do that research. And once you've got all this together, you can then enter into negotiations with your buyer or seller. You've got the information you need to do a deal, and most importantly, do a profitable deal. Alternatively, if you're selling to consumers, you can now put together your terms and conditions of sale because you know what you're prepared to do and how you're prepared to sell. I'm just keeping an eye on the clock here, but it was that side of it that I wanted to focus on today. The technical elements of actually exporting the forms. Once you've got that information I've just given you, those number of points, your courier will be on carrier, freight forwarder, will ask you for that information. They'll, you know, you'll be able to put your commercial invoice together, and I know Andrew and Rupert will go onto that side of it shortly with the VAT, etc. But you will have that together, so it's all good preparation. Our focus here on buying and selling. You may not be buying or selling. You may be moving goods for other reasons, for testing, inspection, return, repair. There are all special procedures for these. And I'm very happy to, if you've got any questions regarding that, happy to pick that up separately and go through that process. A very short point on Northern Ireland. It's obviously been in the news, and the government are very keen to keep the supply of goods moving to Northern Ireland. There is a lot of support available for you, the government have put in. Please go and look at the Trader Support Service, free service to help you. So again, we can help you with that. There are different regulations, and we're happy to signpost you. Another point, especially if you're a buyer, and if you buy from a number of countries, it's not necessarily EU related, please keep a check, regular check on the import duties. The government is doing a lot of trade deals at the moment, and you may have noticed, especially if you import from other parts of the world, the import duties have gone down. A lot of them have gone down since the 1st of January. Again, this impacts on your commercial model, especially if you're bringing in ingredients to make the product to ship out to the EU. So do regularly keep an eye on that on these databases, and I'll put these through on the chat later. The other thing to remember is for all your imports and exports, you need to keep the information regarding them for at least up to 6 years. Try and keep a file per order. I know it sounds onerous, but all your customer communications, all the documents, especially if you're exporting, the export declaration, to make sure you have proved your goods have gone out of the UK. If you like this format and webinars, there are a lot of technical ones out there. HMRC have done an awful lot, Institute of Export, Chambers of Commerce. Please go and learn the detail, which I haven't time to give you today. The service does finish on the 1st of March, but it doesn't mean to say the support stops. So please go to Chamber of Commerce, go to the Growth Hub for Coastal Capital, and if you've got an international trade advisor, they will be able to support you. Hot off the press yesterday is the opening of the website to apply for your grant. For the government are giving you up to £2,000 to be able to either train in the export procedures, import and export procedures, or to seek professional advice. I recommend you all go. I'll put the link in the chat later. Please go and apply, and that will enable you to get that advice and customs advice support that you may need. I think that's where I will stop at the moment, because there's such a big element of the VAST and the duty part of this, and come back and answer some questions later. Thank you.
Thank you very much, Tracy. As she mentioned, this is a huge topic with such a lot to cover. So do make use of that support and the contact with Tracy while it's on offer until the end of the month. We have got a lot of resources on our website, which I'll get Lauren to share the link in the chat, which has got signposting to lots of the webinars that Tracy mentioned and the Growth Hub. So do take a look at that if you need any further support. So thank you, Tracy, for sharing your expertise there. I'm now going to hand over to Rupert and Andrew.
Thank you very much. So I'm going to give you a summary of the indirect tax changes, first of all, which happened as a result of Brexit. And then I'm going to hand over to my colleague Andy, who'll cover the direct tax aspects. So what we're going to look at here are the key aspects of Brexit, what to consider if importing, what to look at when you're exporting, and some of the more regular problems that we're encountering in trade with the EU. So let's summarise the Brexit changes for you. So I think contrary to, well, when you heard the news on, was it Christmas Eve, that a deal had been done, the BBC reported, I heard them report, the trade deal means that trade with between the UK and the EU is free of import taxes. And as Tracy earlier alluded to, that's not the case. In actual fact, first of all, you have to determine, well, do we meet the rules of origin, which aren't straightforward, I must say. And don't forget that import VAT is due when you import something. So yeah, that's important to understand. There are problems and issues that will arise. Tracy was bang on in terms of Inco terms being most important. You know, those determine who is responsible for what in the process of getting the goods from A to B. Now, the one Inco term, the shipping terms, which are giving us most problems, are DDP, which means delivered duty paid. So delivered duty paid, if you're a UK supplier, means that you have got responsibility for getting the goods out of the UK and also for import into the EU. This has been quite a desirable Inco term for not only large, say, retailers in the EU who've demanded that their suppliers handle everything for them, but it's also quite desirable from our client's perspective in terms of wanting to take the aggravation away from the customer in the EU. So I think slightly contrary to the information that was given to us in the lead up to Brexit, we do actually find that there are a lot of businesses who are wanting to, do business as usual, as it were, business before Brexit, which is just to take the goods from their factory, etc., in the UK and deliver them to their customer. But DDP means, importantly, that you, the UK supplier, will be responsible for the import, and that means import VAT and any duty. It's no longer a simple issue of just taking the goods into the EU. There's a customs border there now, as we know. And that means it's absolutely crucial that you understand who's responsible for making the export declaration and who is responsible for making the import declaration on the other side. Now, one of the key issues that we're finding, something that has been in the EU for a number of years, but not something that customs authorities have really enforced, and that is the how do you clear customs? On the EU side of the channel, we've got the Union Customs Code, and on the UK side, we've now enacted the Taxation Cross-Border Trade Act. Now, what those two pieces of legislation do is say that whoever is responsible, whoever is the declarant for an import or an export declaration, so if you're making an import or an export declaration in the EU, the Union Customs Code says that the declarant must be established there. So if you look at DDP and the UK supplier shipping into the EU and responsible for that import, the UK importer is going to have an issue because they've got to find somebody who is established in the EU to be the declarant on the import. So that means let's look in more detail at what you actually then need in order to be the importer into the EU. Well, your UK EORI will clear the goods leaving the UK, but that will not work when you get to the EU. So you are going to need an EU EORI number first and foremost. And that probably means that if you are the importer, it probably means that you will need to be VAT registered wherever you're importing the goods to. So you could have a number of registration obligations. So you need to think about routes into the EU as well. But in terms of finding a declarant who's established there, well, as Tracy alluded to earlier, you really do need to talk to your agents about this. You will need to find a customs representative, an agent who will act indirectly. So acting in an indirect manner means that the agent acts in its own name. And in doing so, it takes on joint liability for the import taxes, the VAT and duty, with the supplier, with you, let's say you're the UK supplier. But what we're finding there is that not all agents, in fact, it's quite difficult to find an agent who will act in that way because they've got the risk. If they do take on the risk, it means that costs are probably going to be higher. So that's one option, though, finding an agent who will act indirectly. Some countries, such as the Netherlands, have got limited fiscal representatives, for example, who will take on that responsibility. But not all countries, not all agents will. So you need to do a bit of work around that. The alternative, and perhaps the more permanent solution, is to have an EU establishment. And this is probably why you're hearing in the news, etc., lots of businesses setting up somewhere in the EU. And that in effect means a branch or a subsidiary. Branch means having human and technical resources there, whereas a subsidiary can be a standalone subsidiary of your business. If you have a subsidiary there, it means that business, you can sell through that business, and that business will then have a footprint in the EU, meaning that you can import anywhere around the EU, having the ability to use that as the declarant for your import declaration. So that's quite a big issue, quite a big consideration. As I said, EU customs and UK customs have not challenged greatly in that regard, but we are seeing them do so now. So that one issue could hold up your goods if you're not careful. We've had, for example, I had a hauling phone the other day saying a number of my customers, UK customers, goods that I'm shipping into the EU. I've got a number of containers which have been held at EU customs, and they're asking for proof of residence, which they'd found was this point about needing an EU establishment. They've not found an agent who would act indirectly, only one that will act directly, meaning pure agent in the name of the supplier. The other issue that's arisen as a result of Brexit is that to do with trading goods still is to do with the removal or with withdrawal of the use for UK businesses of the 3 simplifications. These simplifications all avoided the need for the UK business to go and have to register the VAT overseas in what was then another EU country. And those are triangulation, call-off stock, and supply and install. I'll just give you a sample of this. Triangulation, for example, was where a UK business would buy, let's say, from Italy and sell to, let's say, the Netherlands, but the goods would move directly from Italy to the Netherlands. The ordinary rules would say the UK intermediary has to register for VAT in either Italy or the Netherlands, but the triangulation simplification avoided that registration obligation. But now that and the other simplifications have gone, it's going to mean UK businesses are going to have some obligations to register for VAT overseas. So watch out for your unusual transactions, or maybe not so unusual now. So let's quickly look through the implications now for imports into the UK. If you're an importer, what do you need to consider? Well, VAT and potentially duty is payable on the imports from the EU. That's okay. In terms of VAT, we've now got what's called post-paying VAT accounting. So what you'll need to do is tell your agent, your customs agent handling the entry, to tick the right box to make sure that then you can account for the VAT on import on your VAT return. So you can pay it and claim it back if you're a normal taxable business able to recover your VAT on your VAT return rather than at the port of entry. If you don't tell them, then you'll have to pay VAT at the port of entry. Duty, of course, is not recoverable. It is a cost, and it all depends on whether the rules of origin have been met, as Tracy said earlier. UK importers obviously need a UK EORI. Now, hopefully you'll have been given that by the government, but if you haven't got one, or you're intending to import from outside the UK, then you need to get one of those in order to clear goods through customs. There are some new rules that were introduced. This is not really as a result of Brexit necessarily, but just because the UK wanted to tighten up on the online sales to private customers, mainly in the UK. The new rule now says that for goods under £135, the seller must register for and pay UK VAT, unless it's selling via an online marketplace, in which case the online marketplace is going to collect the VAT at the point of sale. If you're selling to a business that's VAT registered, then or rather, if you've got a UK supplier that's selling to you, I think it's possible to operate a reverse charge. But it's going to mean there's a lot more sellers who are going to be registering for VAT in the UK. Customs import declarations, as I've said, will be required. And the new rules, the Taxation Cross-Border Trade Act in the UK, are going to mean that a number of EU businesses are going to have to set up an establishment in the UK, unless, again, they can find an agent who will act in the agent's own name. Looking at exports now, which is probably more interesting for you, all exports now will be zero rated, whether they're on a B2B, business to business, or business to consumer, B2C basis. Zero rating can only be achieved and sustained if, as Tracy said again, that you keep the evidence of export. HMRC will check that. You need to have that in an ordered fashion, because if they come and do a visit, as I've experienced in the last couple of years, and they're more focused on exports and imports, as they naturally will be, they're going to want to see immediately that you've got the evidence, some of which has the force of law. So you need to consider, in terms of what evidence you've got, for example, whether there's an accurate description of the goods that are being exported, rather than just something vague like electrical goods. You're going to need commercial invoices with commodity codes and origin statements, etc. And it's important to get the origin statement correct, because all you're going to do if you get that wrong is to give your customer in the EU a potential liability going forward if customs in the EU look at what you're supplying and challenge the origin. So you do need to take some advice, or go to the sites that Tracy mentioned to sort out your origin statements. A UK exporter needs a UK EORI. We know that. Inco Terms, as I've mentioned, are very important. You need to really sit down and agree with your customer what exactly is involved in this Inco Term. I've heard of some hybrids to Inco Terms to facilitate what the supplier and customer wants, but you need to understand that. As I mentioned, if you're a UK exporter, which also has the responsibility under the DDP Inco Terms for being the EU importer, then you've got clearance and compliance issues in the EU. You may need the EU EORI, you may even need an NI, Northern Ireland, Irish XI EORI number, and you may need an EU establishment. And what you probably will need is an EU VAT registration, but you need to understand where are the goods being imported, and will you have multiple registrations. One thing I should say is in July in the EU, there's going to be some interesting changes, similar to our £135 rule that we've introduced in the UK. And that is the import one-stop shop, which will deal with goods under €150. And there's also going to be a one-stop shop, which is for goods moving around Europe, to replace the distance selling rules, which required goods being sold from one EU country around the EU to private customers. You would need to go and register for VAT in that other country if you exceeded a certain distance selling threshold. The one-stop shop will remove the obligation to go and register for VAT in the various member states, and instead mean that you can file one VAT return in one member state and account for VAT according to where the goods have gone at the prevailing rate. So the import one-stop shop and the one-stop shop should simplify matters with a single registration for each. Now, just to cover some of the things, the issues, particular issues we're seeing. I mentioned Inco Terms, and what we are seeing is that customers are not, suppliers and customers are not necessarily agreeing what those really mean. That's one thing. Rules of origin, are they understood? You know, as again Tracy mentioned, if you import goods from the EU and then you re-export them back to the EU, you may have problems in achieving the origin rules, because you can't give a UK, when on the export to the EU, the re-export as it were to the EU, you won't be able to give a statement that the goods have UK origin, because they would have EU origin. You see what I'm saying? So there are some particular issues there. We're finding EU customs authorities are beginning to enforce the Union Customs Code rules, as I mentioned. That's on the establishment point. Amazon and other online marketplaces, they're demanding that UK suppliers become an EU importer. They're demanding that the UK supplier is responsible for the goods getting to their EU warehouse if the UK supplier wants to be part of the pan-European network. And I can understand Amazon not wanting to act as importer for all of those many suppliers. It really wouldn't be practical. So that's why Amazon have done it, and others. But it does leave sometimes a small UK supplier that's wanting to sell via Amazon with that potential establishment or agent problem. There are some issues with couriers. So some of the couriers who are bulk shipping they're shipping a quantity of goods, and they're not seemingly able to apply certain reliefs, duty reliefs that there are, such as return goods relief or outward processing. Those need specific treatment. Other things we're seeing, movements of goods across borders for repair and renovation services. Yeah, the important point there is that only the owner of the goods can reclaim any import VAT. So, we've got a client, for example, that's going over to Ireland, picking up goods, bringing them back to the UK, repairing, enhancing, and then shipping them back to Ireland. The problem is when they ship them back to the island, even if they've applied for reliefs, there's going to be import VAT due on the enhanced value at least, if not the full value. But as they're not the owner of the goods when they're responsible for the import, they've got a problem in recovering the VAT. Moving on to the next point there, very quickly. So, if you need to establish an EU entity, what you need to be thinking about is not only the cost, according to which country charges more for setting up, but you also need to look at your supply chain. You need to understand also the red tape in that particular country. How difficult is it to maintain a company, and the corporation tax and other direct tax considerations of setting up there, plus, by the sounds of it, regulatory, etc. And finally, there needs to be some thought and planning into VAT registration. Do you have multiple VAT registration obligations because of where you're shipping into? is it better to think about another route, another supply chain? So that's it from me. I shall hand over now to Andy.
Thank you very much, Rupert. That was very helpful, and I learn something every time you talk about Brexit. It's very complicated, and you do help to simplify it. I'm Andy Wallis, and I'm a corporate and international tax partner at Kreston Reeves. So I wanted to talk about the corporate tax and direct tax implications of Brexit. I think it's right and important that the focus over the last few months has been on VAT and duty. That is definitely the area where the biggest impact for businesses has been, and it's right that that has therefore got the most attention. However, there are some direct tax implications that I just wanted to flag to make sure that companies were considering those. I think one of the main issues is it comes out of the point that Rupert was making, that companies might need to have an establishment overseas in order to register for VAT and EORI numbers. In terms of setting up that establishment, there's a question as to whether you want to do that by way of incorporating a subsidiary or whether you want to have a branch. Now, there is a slight difference in the way that those are taxed from a UK perspective. A branch is seen as effectively being an extension of the UK company. And what happens is that the profits you make in the overseas territory in respect of that branch are taxed in the overseas territory, but they are also taxed in the UK. And so you potentially have double taxation on those profits. However, the UK tax rules enable you to claim foreign tax relief for the profits for the overseas tax that you pay. So, for example, if you were to pay, if you were to have a branch with a subsidiary, say in Germany, and approximately pay a 30% rate of tax, say in Germany on your profits, you would pay the 30% rate of tax in Germany on those branch profits. But you would also pay the 19% rate of tax in the UK, but you would be able to claim foreign tax relief for 19% of the 30% of the German tax that you've suffered. So in effect, you wouldn't pay any more incremental UK tax on those branch profits. One of the advantages of having a branch is that you are able to offset losses of the branch against the profits of the UK company. So where you are entering into a new territory and you're sort of uncertain of the markets and the opportunity, that can be quite an advantage of having a branch. The other option is to have a full-blown subsidiary in an overseas territory. In that situation, it's very, very clear which profits are taxed in the overseas territory, because you are only looking at a single entity and its profit and loss account in determining the profits that are taxed in that location. And the UK wouldn't have any right to tax those profits of that overseas jurisdiction in the first instance. So there are some differences in approach between deciding which type of entity you would like. And as Rupert has also highlighted, there are some thoughts to be given as to the location of an EU subsidiary or branch, because obviously the different territories around the EU have different tax rates. Now, it really does depend on exactly what you will be doing in that territory, how important that is. To the extent that you're going to have a very, very light touch presence in an overseas territory, then you might not have a significant amount of profits that are going to be taxed in that territory. And therefore, the headline rate of corporation tax might not be that significant. If, however, you are sort of changing the way you operate, and having more of a presence in this subsidiary or branch, then that can have some quite big implications for the amount of tax you'll pay in the overseas territory, and therefore the precise location that you want to establish your entity could have advantages in trying to pick a lower tax rate territory. So those are the points around setting up an establishment. A couple of other points to note are that given the UK has exited from the EU and following the end of the transitional period, the UK is no longer able to benefit from various EU directives, and two in particular are relevant from the corporate tax perspective. There was the EU Parent and Subsidiary Directive, which enabled companies to pay dividends from the EU to the UK free from withholding tax, providing there was a sort of 10% share relationship. And also the Interest and Royalty Directive, which enabled people to pay interest and royalties from the EU to the UK or vice versa, free from withholding tax, where there was also a 10% shareholding relationship. Those directives no longer apply, so it is necessary to think about whether there could be any withholding taxes on the payments of dividends, interest and royalties. We are lucky that the UK has one of the widest networks of double tax treaties in the world, and actually we've got some very, very good agreements across the EU, and in the vast majority of circumstances, withholding taxes can be reduced to zero. There are exceptions, and for example, dividends paid from Germany to the UK, the reduced rate of withholding under the double tax treaties is 10%. So there are some additional tax considerations and potential leakage to think about there. The other really important point to make is that in order to benefit from the double tax treaties, it's necessary to claim for the reduced rates of withholding in advance of the actual payment. Otherwise, you can end up with the requirement to have withheld, and also there can be a grossing up of what amounts you should have withheld. The other sort of point I wanted just to touch on was transfer pricing. We're seeing that many clients are restructuring their supply chains as a result of Brexit. For example, businesses that historically imported, say, from the Far East into the UK, and then potentially shipped from the UK out into the rest of Europe, are looking at changing their supply chain and potentially importing goods directly into the EU without the goods ever coming into the UK. And more to the point, the fundamental relationships of how who's managing the processes and where the people and resources underlying that supply chain are located has potentially moved jurisdiction. And therefore, it's necessary to think about whether your transfer pricing arrangements need to be reviewed in light of this. I appreciate that some of you may well be able to benefit from the small and medium-sized enterprise exemption from transfer pricing rules from a UK perspective, but it may still be necessary to think about the transfer pricing implications in the overseas territories. So to the extent that you are looking at restructuring your supply chains and changing your logistics routes, please don't ignore that, because there may be work you need to do around that. As I say, there are far less implications from a direct tax perspective than VAT and duty, but those are the things we are seeing companies sort of finally getting around to considering now that the immediate challenges from an indirect perspective have been addressed, and I'd encourage you to also think about that. That's it from me. I'll hand back to Tracy. Thank you.
Thank you very much, Andrew. I just want to say a big thank you to Tracy, Rupert and Andrew for joining us and sharing so much information this morning. Tracy has put several links in the chat, so please have a look, and there are also the contact details for all the panelists. Just before we come to the Q&As, there have been many questions and concerns around freight, which have been touched on a little this morning. One of our members, a local freight company, Sussex Transport, are offering a free freight Q&A service. So if you have any questions, you can email freight@sussextransport.com, and these questions will be directed to the correct agent, whether that's air, sea or road, to provide the most up-to-date guidance to your questions. So we'll pop that link in the chat for you as well.